Welcome to the Intermarket Analysis video update. This is a video that I do every week where we look beyond just the S&P 500 to see if we can get some any insight as to what's happening in other markets, which may have an impact on the S&P 500 itself. And this is being prepared for Monday, July 28th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Some of the areas that I'll cover here. First, we'll go through valuation. We look historically at past earnings reports and compare them to the current price of the S&P. Then we look forward at historical prices. Then I go through a pretty extensive study between growth and value. When growth is outperforming value, that's when the market is more positive. And we're seeing that right now. Then another area that I'll go through is inflation. We want to keep an eye on that. Now, it seems to be taming a little bit right now, but still, this is an area that the market doesn't like. When inflation is really going up, that could actually induce the Fed to raise interest rates rather than lowering them, but it seems under control for the time being. We look at some other markets outside of the stock market itself. Sometimes that can have an impact on the S&P itself as well. Then we look at the 11 sectors that make up the S&P 500. We look at them individually, and then we do a ratio to see how is that sector performing when compared to the S&P 500. We look at a lot of different indexes that are outside of the S&P and also have an impact on the S&P itself. Look at correlations between different markets and some very long-term trends. Then finally, I'll go through a positive list and a negative list. The negative list is pretty short right now, and the positive list is pretty strong, as for the most part, things are looking positive for the time being. Okay, first we look at valuation. Now, this is historical, and we compare earnings that have already been released with the current price of the S&P. We're well above the red dashed line, but we've been above this for years now. So the market can be in this kind of a state and still go up even more than what it's been going up lately. This also looks at that same thing, but goes all the way back to 1980. And you can see that we're very, very far above the red dashed line. The red dashed line's at about 43.33. And we're 2,000 points above that with the S&P 500 itself, roughly. Okay, then Robert Shiller came out with a variation of looking at historical earnings and comparing them to price. His reading is coming in at 38.97. That's well above the median and the mean between 16 and 17. You can see this chart is really going up. So this also shows that we are overvalued, but the market doesn't do that. But even when we look forward, the market is still overvalued here. The purple line, or the mega cap 8, coming in at 29.6. The S&P, we get a little nervous when it goes above 20. Right now it's at 22.4. So as we get into the latter part of July and going into August, sentiment is very positive. The market seems, no matter what happens, it seems to go up. We're just setting recent all-time highs, both with the S&P, the NASDAQ 100, and the NASDAQ. And when the market's looking a little too exuberant like it is now, that's when we need to be careful. If we do start to fall, then these lines would come down with it, and we can see if we get a little bit more fairly priced as far as a valuation basis. Then this is looking out here. We have tech, media, and telecommunications, or I just call it communications. These are the three big growth areas that we look at. I also include discretionary as a growth area as well. And we see the blue line here, the light blue line. This is just what is the PE ratio. And we're coming in well over the 40 level when we just look at this. When you take that out, we're a little bit more fairly priced here, but still we're above that 20 level. So this is also suggesting that the market is expensive. And we look at growth versus value. First of all, I just look at growth by itself. Excuse me. I just look at growth by itself, where we're setting all-time highs with the pure growth index. We're not at all-time highs with the value index. It is in an uptrend as well, But where we get the insight is when we do ratios between the two. We can see here that growth is outperforming value, value is underperforming growth. That's what we want to see in a more positive environment. Then I look at a number of different charts to see, are we witnessing the same thing across a multitude of time frames for the charts and a multitude of different ways to measure growth and value. So here is the growth ETF versus the value ETF. Growth is outperforming. This is an inverted version of that same chart showing how value is underperforming. And what we've been seeing now for quite some time, the growth index is outperforming the value index. The value index, excuse me, the value index is underperforming the growth index. Then this is a ratio between a growth ETF and a value ETF, and this is holding up quite well above the rainbow. This is that same ratio but reversed, showing how value is underperforming growth. Then we break it out a little bit according to what size stocks are. These are the small caps, and we've been going sideways a lot with this ratio, but for the most part, we're in an uptrend and we have been improving. Now, we've seen some improvement with the small caps, but we've seen this before. They have a little good upward period and then they kind of go sideways or they start to fall back down here. But when we look at just the growth to value ratio, still looking pretty solid there. Mid-cap growth to value, also starting to break out here. Also been underperforming, but showing some improvement with the mid-cap index. This is the one that I look at the most, S&P growth to value. We're breaking out and setting a high here. That's quite positive. Then we keep an eye on inflation. We're a little bit concerned about this. We're above an advancing moving average with the monthly chart of the CRB index. These are commodities, and when commodity prices go up, that could be inflationary. Then we look at a ratio between inflation and deflation, a monthly chart. This is really starting to go up, and we're seeing the moving average itself starting to turn up as well. Now, this is a monthly chart. It won't be completed for another month until we finish out July, but this does update every day throughout the month, and right now it's seeing a bit of a spike up with inflation starting to outperform deflation. CRB index in an uptrend, but not really breaking out all that much. Baltic Dry Index, it is in an uptrend here. That could be potentially inflationary to ship products around the Baltics. And then inflation expectations, they were going up. When I did this video a week ago, we were a little bit concerned that maybe we were breaking out a little bit here. Now we're starting to come back down a little bit. Another ratio between the inflation expectations and TIPS, Treasury inflation protected securities, not really seeing one outperforming the other right now. A lot of sideways action recently. Then these are some of the other markets that we follow. Aluminum, which is bouncing back up, but still in a downtrend. Corn going down and in a downtrend. Wheat is also in a downtrend. Fertilizer going up a little bit here. So we're a little bit concerned about that from an inflationary standpoint. Lumber is also in an uptrend. That going up could be a little bit inflationary. Oil is really just kind of hanging out around the mid 60s right now. This is very geopolitical sensitive here, where we are still in a downtrend with oil overall. We'll look at gold to oil. Gold's just been going sideways. Oil's been not really doing all that much, so we're not seeing this ratio changing very much here. And then we look at a correlation where we look at the 10-year yield here in black, and then we also keep an eye on oil itself, and we see that there's a fairly strong correlation between the two. If they're going up, they're both going up together, or they could be going down together. Then we look at gas, which is in an uptrend, but just kind of chopping along sideways. Heating oil, which has really gone up here, and we're just starting to see a new positive trend here. Natural gas kind of just conglomerating sideways here, but it's still hanging on to an uptrend. Diesel has been going up too. That potentially could be inflationary. Copper, no, going up, that could be inflationary. But at the same time, when copper's going up, that's a good show that there's economic confidence looking forward. And the copper to gold ratios. Gold's been going sideways, copper's been going up, so we're seeing a real change over here with this ratio. Not enough to generate a golden cross yet, but we're getting close. And then we look at that same ratio, the black line, that's the copper to gold ratio, which has been declining. Now it's starting to go back up. And then we just give it a little bit more context by looking at the 10-year yield in red and the 2-year yield in green. And they've been disconnected from each other now for quite some time, where typically they don't get all that far apart, even though they're on different scales, and they tend to move in the same direction. But now, ever since the COVID lockdowns, we've been seeing the copper to gold ratio going down as interest rates were going up. Gold, as I said, pretty much chopping along sideways, but still in an uptrend. Silver in an uptrend, although it had a pretty bad day on Friday. Then we look at a gold to silver ratio, and we're still seeing this ratio coming down. That means silver is outperforming gold. And then we plot that with the US dollar index. We try to follow the interplay between precious metals and the dollar index. And they're having a slight tendency to go in opposite directions right now. And here's the dollar, which continues to be in a downtrend. The euro, which is in an uptrend as the dollar has been going down. Then we also plot this with the three big currencies here, with the Japanese yen really going sideways a lot lately, where the euro has been going up as the dollar index goes down. Then I break them out here. We're still in an uptrend with the Japanese yen outperforming, but lately, going back to May or so, this has really been going sideways. And the euro, which has been outperforming the dollar, it's in an uptrend. And the British pound, even though it's falling back right now, it's still in an uptrend compared to the dollar. Then I show this off and on in the daily videos. This is the weighted version of the S&P. So the big stocks have more of an impact. And then in red is the equal weight version. And we're seeing more participation here. We were getting a little bit concerned as the red line was underneath the bar chart. Now they're both going up, and that's positive. But now we're seeing more of the S&P stocks actually starting to participate in the general upward move that we've been seeing, and that could be taken as more positive. But we're also seeing a bit of a lag with the big stocks that really drive the indexes. That could be taken more as a negative. And the equal weight versus the S&P, this is a ratio. When this is going down, that means the S&P equal weight is underperforming. So it's still having a tendency to underperform overall. Then we look at the NASDAQ 100 and compare it to the S&P 500, both setting all-time highs on Friday, but the NASDAQ 100 is doing even better. And stocks versus commodities, stocks are outperforming commodities. This is an inverse of that same thing. Commodities are underperforming stocks. The NASDAQ is outperforming the S&P 500, and that's more tech. That's positive. Even though both are doing well, the NASDAQ setting all-time highs also. And then the S&P 100 is outperforming the rest of the S&P 500. Those are the bigger stocks that are outperforming. This is kind of interesting, though. If you go back to late spring or so, the NASDAQ 100 was really outperforming the rest of the NASDAQ. Now we're starting to see this ratio continue to go down. Now that's positive in that we're seeing more stocks participating, but that could be negative because the NASDAQ 100, those are the really big mega cap stocks, and they're underperforming here. So you could look at this in a positive way or a negative way. Mega caps are outperforming the equal weight version of the S&P. Even though some of them are underperforming, they're doing better than the broader equal weight index. Then small caps continue to underperform the S&P 500. We've seen that for a while. This is that same ratio. The red line continues to go down. That's the ratio between small caps and the S&P, where the blue line is the S&P itself. Robotics AI ETF, seeing a little bit of push here. Now, there was some news that came out that was positive for AI. Some trade deals are being made, and so this is seeing a bit of a bounce right now. And for quite a while, we saw that the robotics and AI ETF was really underperforming the tech sector. It's still doing well. You go over here, and coming up out of the April lows, it's been doing well, and it's been in a basic overall trend when you look at it by itself. But when you do a ratio, it's really been underperforming here. We could be seeing some improvement as we're going more up into the rainbow right now. Mega cap growth, uptrend, setting recent all-time highs here. And the Dow Jones Composite, just setting a new golden cross here. This was one of the last holdouts. The Dow set a recent golden cross, and a lot of this strength is coming from the Dow. We're seeing a bit of a bounce back to the utilities as well. And transports are improving a little bit. But this just takes all three of those indexes and puts them together. And small caps continue to underperform the tech sector and have been for quite some time. This is a little bit of a concern. This is part of the warning sign that I've been watching is when we see semis outperforming tech, this ratio goes up. It's been underperforming the last few trading sessions. As we get deeper into July and start to finish out the month, we're wondering, okay, is the market starting to become more defensive if we see this ratio going down? Now, that's not evidence in and of itself. That's just one piece of the overall puzzle. Because in 2024, we saw this ratio really go up. It topped out right about now, right about July, and started to go down. And it continued to go down. But in 2024, we were still setting new all-time highs. And then the Fed came in and cut rates in the fall of 2024. And that really helped the market. So it doesn't mean that when this ratio is going down, that the market's going down. It just means the semis are underperforming the tech sector. And that's a huge part of the tech sector. So we want semis to do better. Then low volatility stocks pretty much going sideways, but still in an uptrend, but they're holding up right now. These are the stocks that folks get into when we are starting to get more defensive with the market. But when we do a ratio, really underperforming the S&P. So that's more positive for the market. Then we take out US stocks and compare them with world stocks. This is doing quite well. International stocks are still outperforming. That's what this chart is telling us because this is all world excluding or except US stocks right here. Then when we put that back in the equation, we put US stocks back in as the SPY, you can see it's going up, but it's not going up with all the enthusiasm as we saw in the previous chart. And energy is continuing to underperform tech. Growth is still outperforming bonds, which are more conservative. And the tech sector is outperforming the 10-year treasury yield. This is an inverted version here where the 10-year yield is underperforming the tech sector. Discretionary improving, recent golden cross here. This is showing some improvement. We'd like to see this continue to go up to be more positive. Staples are underperforming discretionary here. So that confirms what we saw in the previous chart. Gold, it's just been going sideways as the S&P has been going up. So that's what's causing this ratio to go down. But the dollar's been going down as gold has been going sideways. So this ratio has actually been holding up quite well. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at the advanced decline line across a multitude of different indexes. Still looking really solid here. All the moving averages are going up, and the advanced decline lines are above all of the moving averages. Then we look at what's called traditional Dow theory, which just looks at the Dow and the transports. And we're doing well with the Dow here, but we're not back to an all-time high. We are improving with the transports, but we still have some overhead resistance and previous highs to clear and quite a ways to go to get back to an all-time high. Now, I also include utilities as part of that mix, mainly because of the Dow Jones Composite Average, which includes all three. Utilities have really been going up, and I explain this from time to time. Typically, utilities are considered to be defensive. These are widows and orphans because they pay good dividends. Stocks that you just buy and forget about it, and then the dividends go into your bank account and you can use it as income. Because of the big shift over to AI and electric vehicles and all the Bitcoin mining and other cryptocurrencies, a lot of power is needed, a lot of electricity is needed, and that's almost made a case for utilities being a growth area because there's this really huge need for electricity, especially. They're starting to rebuild nuclear power plants, and they're wondering, okay, where are we going to get all this electricity from? And that's again, making the case that utilities are switching back and looking to be more of a growth area. And then we look at the Dow versus the transports, and the Dow's been doing okay, but when this ratio goes down, that means the transports are actually outperforming. And here are the transports. Not doing great, but not doing terrible. We're right. These red lines that I have here are previous highs that was acting as overhead resistance. So we are showing some improvement, but we still have a ways to go back to get to the all-time high that was set in late 2024. And then we do a ratio between the transports, which is a Dow index, and the S&P. So it's not a pure ratio when we look at this, but this continues to show how the transports are underperforming. We also look at the correlation, though, between the S&P 500 and the Dow transports, and that correlation is getting stronger as it actually had worked down to more of a neutral reading recently. Then new Dow theory, instead of using the Dow, we use the S&P, setting all-time highs. Instead of using the transports, we use the NASDAQ, all-time highs here. Now, this is also encouraging as we're seeing some of the broader parts of the S&P 500 see some favor. Now we're back to setting an all-time high with the equal weight. So that is positive there. And then we look at an equal weight version of the QQQs, which is the NASDAQ 100. That's also setting an all-time high. So that's showing more confirmation where this was lagging before, and that was a bit of a negative divergence. Now that seems to have been taken care of. The FANG index going sideways a lot, but in a pretty solid uptrend. These are the really big stocks. Wilshire 5000 setting a new all-time high and in an uptrend. Total U.S. stock ETF, uptrend, setting a new all-time high. Microcaps recently just generated a golden cross. Now the microcaps, the smaller ones, they're in an uptrend now, but we're still waiting for the small caps and the mid caps to generate golden crosses as well. NYSE composite setting an all-time high. This is good. It's a broad market measure here, and it's also in an uptrend. Then we look at U.S. versus international stocks. Most of the power is still coming from international stocks, but this index is still doing quite well. High leverage loans. This is another barometer of the economy. Looking good, well above its 50-day moving average and in a pretty solid uptrend. ARK is also in an uptrend. Bitcoin got hit a little bit in Friday and over the weekend, but it's still in an uptrend well above its 50-day moving average. Emerging markets looking pretty solid here. This is an area that's seeing more of an uptrend of what we're seeing right now. Even though we're setting all-time highs with the S&P, we're not at an all-time high here with this ETF, but it is in a pretty solid uptrend. And then the Japanese Nikkei finally breaking above this red line. It's just been kind of floundering around here for the last couple of years. It's finally making a move. Now, there was a trade deal announced between the U.S. and Japan, and the Asian markets, specifically Japan, really liked that. And that's what's been giving a bit of a boost here to their index. Semiconductors, not at an all-time high now, but we are in an uptrend. And we're setting all-time highs with the S&P, NASDAQ 100, and NASDAQ, but this is not back to the all-time high. This is a bit of an underperformance that I'm talking about. Now, it could rectify itself. We could see a really strong upward move and take care of that. But in the meantime, that we don't know if that's going to happen. We're seeing them underperform just a little bit recently. And the semiconductors here, still really solid, but not setting all-time highs. And then the AI and tech ETF, this is doing better. And this is kind of a variation of the robotics and AI ETF. This is a different ETF where this one's looking more solid. Then we keep an eye on the home builders. Pretty strong correlation when we look at the top chart and the home builders ETF here. The correlation down here is pretty strong. We look for divergences, and we're not really seeing any right now. We're seeing that they're tending to go in the same direction. And we keep an eye on international long-term trends here, where China is now starting to turn back up. We're pretty much flat with emerging markets, but a slight upward move here, trying to bounce back up, not quite positive in Europe, actually declining a bit here in Japan, and we're flat to still slightly declining with the S&P. Now, again, this is a long-term oscillator. It moves much slower than like a MACD or a PPO or a PMO or any of the shorter term oscillators that I also look at. Then we do a ratio long term. This is a monthly chart. Still looking okay here when we compare US with global stocks. We're still going up from the moving average, and we're flattening out after we had been declining when we look at the PPO, another momentum oscillator. Then bonds, this is bonds based on price. We're coming down here. Now, when this goes down, that means interest rates are going up. But we did see a bit of a bounce in Friday's session. Then total bond ETF, these are bonds based on price. That's in an uptrend. And then this will finish out after Thursday because we're going to be finished with July. So it's not official yet, but so far, when we look at the monthly chart of the stock to bond ratio, it's setting new all-time highs here. This is a daily chart showing how bonds are underperforming stocks. Prang World Bond Index in an uptrend here, showing a little bit of improvement lately. This is the one that we saw a recent golden cross with the Dow Jones Corporate Bond Index. Those are showing some improvement, but not quite back to their all-time high yet. Investment grade bonds, these are more conservative bonds. They are also still in an uptrend. Then we look at a stock to bond correlation, pretty strong correlation. So if bonds are going up, stocks are going up right now, and vice versa. And these are high yield bonds. We call them junk bonds. They're setting recent all-time highs here. Folks don't mind assuming more risk to get a better yield. And we look at a ratio between junk bonds and more conservative bonds like government bonds. That's still kind of going sideways overall here with this ratio, and it's pretty much in the middle of the rainbow. Junk bonds also doing quite well right now. And then we compare junk bonds with government bonds. This is continuing to go up and setting new all-time highs. And we're still establishing this higher range with the 10-year yield after we had seen 40 years of lower highs and lower lows. This is a daily chart where we were coming down a bit here with some of the yields. Then we started to go up for a few days. We're watching that 4.5% level with the 10-year yield. That seems to be when the market gets a little nervous about rising interest rates. This is a weekly chart, and we are watching the red line here. These are Japanese rates still going up, and that could put some pressure on things if this continues to go up with the bonds for the 10-year yield. And we look at the volatility of bonds. That's been dropping off lately. That's measured by the MOVE index. Stock volatility has also been dropping, and the correlation between the two measuring volatility is still pretty strong. Then we look at a number of different ratios here. This is bonds to stocks, showing how bonds are underperforming stocks. Then we look at the S&P 500 with short-term bonds, setting a new recent all-time high here with this ratio. And we kind of look at the same thing, but we look to see if we're getting the same results. This is the S&P 1500, also with shorter term bonds, setting a new high with this ratio. A broad market measure with 3 to 7 year bonds, also setting a new high. This is more positive for the market. The tech sector doing really well when compared to 3 to 7 year bonds. Then we look at the S&P 500 and the 10-year yield. The S&P 500 is outperforming. Then we look at the long-term monthly chart of the 30-year bond. This continues to be going down, and the moving average is starting to go back down. And we look at another long-term ratio, the long-term bond and commodities. That's continuing to decline as well. And we look at the sectors, materials, just generating a recent golden cross here. But when you compare it to the S&P, underperforming. Communication, a big growth area, came down a bit here in Friday's session, but it's still in an uptrend all by itself and doing okay, but starting to trail off a little bit. This is another one of those little clues that we're watching. If we were still getting ready to be more positive as we get set to go into August and September, this ratio would probably continue to go up, and it's actually starting to trail off. Now, it's still positive, and we could improve from here, but this is part of just what we're watching. This started near the earlier part of July, and as this ratio has been coming down, could the market, the smart money, be starting to get a little bit more defensive? And we look at energy, which is still in a downtrend, kind of bouncing around. It did bounce off its 50-day moving average, but when we compare it to the S&P, in a pretty significant downtrend. Financials also looking good by itself, setting a high here with this particular ETF, but when we compare it to the S&P, underperforming under the 200-day moving average. And I've been showing this chart for the last few weeks. It seems like in the daily videos, we would like this to improve. And it's doing okay, but not that good either. Then industrials setting a new high here and one of the stronger areas. This bodes well for the economy. We're in an uptrend and it's outperforming the S&P. Then the tech sector setting a new high here. and one of the stronger areas. Now this is falling back a little bit, but not we're not down below the moving average, at least yet anyway. So this is still showing how tech is outperforming, and that's a growth area. Real estate just kind of has a good day, has a bad day. It's trying to generate an upward trend here, but when we compare it to the S&P, continuing to underperform. Staples really going sideways a lot right now and underperforming when we compare it to the S&P. Now, this is positive for the market. If we start to see this ratio going up, that would mean the market's getting more defensive. But for right now, this ratio continues to decline. Utilities seeing an upward move here. Excuse me. Yep. Okay. There we go with the throat clearing. And really doing quite well here with the utilities, but they're still in an uptrend compared to the S&P. They were starting to underperform. Now we're seeing a bit of an improvement along the way. And I also look at an S&P to utilities ratio. When this ratio is going up, that means the S&P is outperforming. Then falling back just a little bit right now. Not seeing an awful lot of conviction. Healthcare, defensive in a downtrend and underperforming when compared to the S&P. Then discretionary, another growth area. Recent golden cross here, still having a ways to get back to an all-time high and not doing great, but kind of chopping along sideways when we compare it to the S&P 500. Semiconductors in an uptrend, a little bit off of the all-time highs. Another, okay, are we getting a little more defensive here? Some pretty big news came out this week about trade deals and things like that, and you would think this market's still strong, but you'd think it would have been even stronger. The Dow Jones Semiconductor Index, not too far from all-time highs, but in an uptrend as well. Then we look at a long-term chart. This is the 200-week moving average. We finally found some support. This is when we were coming down in March and into April, and then bouncing up off of that. Then we look at the semiconductors, a growth area, compared to the Dow. This continues to improve. Now it's kind of going a little bit sideways over the last few sessions. We want to see this get back up to the blue line. And gold, even though it's been going sideways, still the best performing asset in 2025. Stocks are in second place. Commodities are in third place. We're pretty much back to break even with the red line. That's oil. A little bit of an improvement with bonds based on price, and the dollar continues to be the worst performing asset in 2025. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Correlations going in opposite directions. The S&P is going up as the dollar's been going down. S&P to oil also. S&P has been going up for the most part. Oil has been coming back down after it started to go back up there, but they're seeing an inverted correlation. And then the S&P to the 10-year yield also tending to go in opposite directions. The S&P has been going up. If interest rates are going down, that is more positive for the S&P. Also, the same thing, we're coming right out of the neutral area here. Slight tendency for the tech sector to be going up and then interest rates to go down. That is more positive. And then we also look at the S&P to the 2-year yield. That's still neutral right now. And then some long-term trends here. This is a monthly chart of the NYSE setting a new high above an advancing moving average. And the copy curve, again, this will be completed once we finish the month, but it's still going down. We've been going down since the beginning of 2025 with the momentum. And another monthly chart here with the NYSE record high percent index. This is going up, and that's positive. Then a monthly chart of the S&P above the advancing moving average, and we're turning back up and looking more positive here with the PPO momentum oscillator. Then the S&P on top, and then a ratio longer term. Now, shorter term, stocks are outperforming commodities. Longer term, according to this ratio, they are underperforming. Then the U.S. stocks, as measured by the S&P and a global index, still in the bigger picture, U.S. stocks are still outperforming, but the KST continues to be negative. Then we have a positive list here, and pretty much everything on There's very few negative things right now. So we have growth and value, which are, when you look at them by themselves, they are positive. Copper is positive. The euro, the British pound, and the yen compared to the dollar. CRB index, gold and silver, the low volatility ETF going sideways. We're going to be keeping an eye on that as we finish out the month of July. Mega caps are in an uptrend, as is tech. Semiconductors, the different ways that we look at the semis. Staples are still in an uptrend, but really underperforming the S&P. Bonds based on price are looking positive. The Dow Jones Composite, which just generated a recent golden cross. And then we have the Dow, the NASDAQ 100, NASDAQ, NYSE, Microcaps, Wilshire, and Total US Stock ETF. Those are all in uptrends. We're waiting to see if the small caps and mid caps will generate golden crosses. The FANG index is in an uptrend. ARK is in an uptrend. High leverage loans, that's good for the economy. That's in an uptrend. Emerging markets, all stocks, and Bitcoin. Then on the negative side, pretty short list. The dollar, mid caps and small caps, which I've already talked about there. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.